good afternoon, and welcome to our panel on relaunching securitization to better finance the European economy. This topic has been addressed in a series of reports that have come out recently, including ones from former Italian Prime Minister Enrico Letta and former Bank of France Governor Christian Noyer. The Letta report defines securitization as a unique link between credit and capital markets, and says that increasing the use of securitization brings two key benefits. Broadening and diversifying the pool of assets available for investments, and unlocking banks' balance sheet capacity to facilitate additional financing. And that financing point is going to be key, I think, throughout this conversation. It also describes securitization as a means of financing the green transition. So if that sounds good, and I think it does probably for most people in this room, the question is, why isn't Europe doing more of it? And we also need to discuss another issue that has recently come up, which is the result of the European election held over the weekend. And while it's true that the makeup of the European Parliament is roughly the same as it was before, in France and Germany there was, I don't know, you could call it a shellacking, a drubbing, a thrashing that the ruling groups got in those elections. So it seems worth asking whether there is any chance of progress on issues of securitization, capital markets union, banking union, Solvency II, given those results and given perhaps the change in leadership or lack of leadership that might be coming from France and Germany. But before we even begin to attempt to look at some of the technical issues surrounding securitization, I'd like to start with a bit of history, follow that up with a bit of politics, like I just mentioned, and then we can talk about some specifics of whether we might advance or not. So here with me today to discuss these issues are Nathalie AUFAUVRE, Secretary General of the Autorité du contrôle prudentiel et de résolution, if I can speak. Next to her is Fabrice DEMARIGNY, partner and member of the Group Governing Council for Mazars. Next to him is Alain, Chairman of Corporate and Institutional Banking at BNP Paribas. And all the way on my left is Alexander BATCHVAROV, Head of International Structured Finance Research at Bank of America. Also, I'd like to warn you all that I am American, so please don't be alarmed if I refer to my panelists by their first names. So to start with, Fabrice, you have a long history with Capital Markets Union, so if you could please provide us with a bit of the story of how we got to where we are today and how CMU ties into European securitization or the lack of it.
Thank you, Alain. Thank you, ladies and gentlemen. Thank you for inviting me to this panel. But I think indeed it's not irrelevant to recall a little bit on how we are, the situation in which the EU is about securitization, because it has a very reduced securitization market compared to the size of its internal market and an economy that is mainly financed through a very active banking sector, very diversified, and nevertheless a reduced securitization market. And that will help probably to understand where the solutions and the priorities should be. The whole thing started, as you know, and you will remember, with the subprime crisis in the US, where mispractices in the originators triggered a devastating effect on the whole securitization market, the banking sector itself that spread around the whole planet. And in response to that, global policymakers conducted, I would call it a quick, maybe too quick, one-size-fits-all regulatory agenda to avoid a new crisis, because it went up to tapping taxpayer money and try to stabilize the market again. And in the EU, that regulatory reaction did not follow the two very basic principles of regulation, which is, number one, regulate where there is a failure. And the fact is that the EU securitization market did not fail in 2009. And the second principle is calibrate the regulatory measure with the reality of the market you have to regulate. And here again, in the EU, many measures were inspired by international policymakers and the US regulatory response, which translated into a regulation that was very prescriptive and very strict. Not in all aspects. I think the simple, transparent, and standardized regulation, STS regulation, introduced very relevant aspects about a proper level of due diligence, a retention for the originator to have skin in the game, and more transparency, which was really welcome. Now that translated maybe a little bit in burdensome administrative paperwork for originators, difficult at the beginning for practitioners, but has now become easy to implement. And more slowly, and maybe still slowly, acquaintance by the supervisors with this market, and which they are not always up to speed. But all in all, the effect of the market and in the size of the market was mainly caused by the introduction of capital requirements for banks and insurance, additional capital requirements for originators and for key institutional investors, mainly insurance companies. And even if quantitative easing, low interest rates, the fact that the proportion of the mortgage market of fixed interest rates is higher in Europe than elsewhere, did not favor the market to be revitalized. The fact is that all this regulatory agenda has made the EU securitization market losing 60% of this activity in volume. So revisiting the STS, which is the whole thing we are discussing today, has been in the agenda now for quite a while. In fact, it has been reviewed already, but for minor adjustment to increase the scope and maybe adjust few requirements, but not in a manner that will revitalize the whole market. And if I made just one point before concluding on recalling the history, I think securitization was introduced in the EU discussion as part of the Capital Market Union. But in fact, securitization is the perfect example of the synergies between the Capital Market Union and the Banking Union. Because the whole purpose of putting into the market loans, packaged loans, and spreading risk in the private investor arena alleviates, it's supposed to alleviate the balance sheet of the banks and then allowing banks to a higher capacity for bank lending. So the connection between the CMU and the Banking Union is really at the core of this file, and I think for the future, where the Union has financing needs that are huge, and I'm sure colleagues here will mention it, it's a fantastic tool to respond to that challenges.
Thank you. So you brought up banks in particular at the end. So Alain Papiasse, you know, from your position at BNP Paribas, you know, I guess one, do you agree, and why do you think securitization should be a top priority for Europe to increase the size of that market?
But it should be a top priority for a very simple reason. All the texts around the Capital Market Union, for what they are, Banking Union, Basel III, were written and discussed roughly 14 years ago. The world has changed a little bit in 14 years. You know, when you run a company, I think the first thing you are judged on is strategy, but agility. Then today we are trying to put a little paint on something which is totally outdated. Europe has changed, the world has changed, and we just have a little challenge going forward, is that we need to find 600 to 800 billion a year to finance.
What was that number again?
Sorry?
What was that number again?
Yeah, 600 to 800 billion a year to finance the energy transition, the digital transition, and some other little topics. The states don't have money anymore, at least part of them. And the ones who have access don't want to finance. Then the only option is private. At the same time, Basel III, for whatever it is, end game, beginning of the end of the game, I don't know, will come on banks and will restrict our capacity to lend. Then what I'm saying to corporates, it's your fight. Because if the banks have less capacity to lend, prices will go up, which is good news for banks' profitability. Maybe not so good news for corporates. Then I think now we've run a marathon for 12 years. We are not yet there. Now it's a race. And I think it's not a question for regulator or supervisor. It's a question for the politics. Do they want Europe to be financed, or do they announce clearly to the voters that all the plans cannot be financed because there is no money? And the only option to do so is securitization.
We'll come back to politics in a minute. We'll spend time on it, again, particularly following the EU elections the other day. But first, if I can go to Alexander. You're not based in France, and so I'd like to get a bit of a broader perspective from you. How do you perceive the securitization market in Europe? How does it compare to other markets? And for you, is there any opportunity at the moment, or is it essentially a dead market for you?
Thank you. So because I'm a researcher, I have to look at numbers, right? It's very easy. And that would illustrate very quickly the answer to your question. If you look at total Europe, issuance per annum is 100 billion. Of that, about a third is UK. So let's exclude UK. The Eurozone is 60 billion, give and take. And of that, half is CLOs or leveraged finance. Only 30 billion is auto loans and mortgages and consumer credit. And there's almost no SME. If you turn to the other part of the market, which is probably the most developed part in the world, that's the synthetic securitization market, it's about 150 to 200 billion notional per annum, which converts into about 15 to 20 billion risk transfer. Majority of this is corporate, and still a small portion is SMEs. But luckily, there's enough portion of SME to support the market. So what that tells you is that if you are sitting as an investor and you have to invest 100 billion, are you going to go after a market which issues 30 billion per annum? Or are you going after a market of 60 billion, or with UK 100 billion, or with the synthetic 120 billion? Or are you going to go after a market which issues 1.2 billion per annum, which is US? Or a market which is GDP many times smaller than Europe, but issues many times more bonds, like Australia. So that's one thing. Is it a burden or is it an opportunity? Well, the burden is the regulation that created incredibly high cost of entry, both as an issuer, as an investor. We lost a lot of investors in the last 10 years because due diligence requirement, very detailed, regulatory capital requirement, especially for insurance companies, very high. Different treatment for securitization, STS, non-STS, under LCR, and so on. So you have very big burden to comply with, which costs money, and it's usually helping only big investors who can commit the resources to build the portfolios. On the flip side, for issuers, there is a very interesting paper by one of the chief statisticians of ECB who showed how detailed and burdensome the disclosure is. And when you put all the different 5-6 reports which the banks have to report for securitization, we're looking at, from memory, 8,000 items. So think about an issuer coming to the capital market and producing 5 different reports to satisfy many different requirements, and what is the cost to that? Let's just look at that angle, and let's not go into the other dimensions of the market. So it is cost. Reducing the cost through all these different burdens that were introduced would probably help both investors and issuers come to market, and would help probably bringing the gap and providing the financing for the economy which needs.
Got it. Thank you very much. So Nathalie, you are the representative of the, not a regulator per se, but the prudential, the authority side. So not to put you too much on the spot, but sort of from that prudential perspective, what do you think of securitization in Europe? And what do you think would change if its use were to expand significantly? And how would you go about expanding that use significantly?
Yes, thank you. And thank you very much for inviting me. Maybe 4 comments. A bit to reply to those my precedent speakers. First question, is securitization underdeveloped in Europe? Yes, figures were given, but it is worth noting that in terms of market trends, we can observe similar developments since the great financial crisis in US and in Europe, in the sense that in both regions, they have not recovered their previous levels yet. Outstanding amounts are rather stable if you take out agency securitization. And
sorry, by agency securitization, you mean like Fannie Mae, Freddie Mac?
Yeah,
okay.
Exactly. And they are around half of what they were before the great financial crisis. It's just to mention that it has decreased in Europe compared to 2008, but it has decreased also in the US compared to 2008, at least for the compartment which is out of the federal agency securitization. Should we develop it further? I fully agree, and even from a supervisor or regulator perspective, we think it can be a safe instrument, and of course, if adequately regulated. It is true that it is still suffering from the great financial crisis, considered as a vector through which the great financial crisis is originated. We think that if we have an adequate regulation, it could be a very interesting instrument. And not only because it can alleviate the size of banks' balance sheet, but also because it can diversify funding for banks. So we are in favor of trying to develop this market. Maybe a third question or consideration: do the regulation and supervisory approach explain this underdevelopment? And maybe it's part of the of my comment. Yes, I agree that regulatory framework is very much on the prudent side, and that it was a kind of reaction of the great financial crisis. And the idea was really to protect investors, individual investors, consumers. So it is very much on the very cautious framework. But I think we have also to take into consideration that it's not the only reason. If we only focus on regulation, it does not mean that the market is going to grow by itself like that. You know very well that there is an interplay between supply and demand. We are not in the same country. Market role is much smaller in Europe for the funding, and it's not only a question of securitization. Of course, during 10 years, we had negative interest rates, so it was really not good market conditions for developing securitization. So we can hope that this is more favorable now. And of course, there is a fragmentation, EU fragmentation. And I mean, it's not because we are going to alleviate regulatory requirements that the EU fragmentation will disappear. So I mean, just to put into perspective the whole vision, the whole perspective, we have to work, and we agree we have to work on the regulatory framework. We can look on what would be more proportionate, where are really the risks, what are the overburden regarding reporting, due diligence, but it will not be enough to really relaunch this market. Just to be clear on that, because we should not forget that other conditions are to be made.
Thank you. So to pick up on your point about the fragmentation in Europe, and this is going to be a question for each of you, I did want to talk about the politics and how that might change things. Two of you have brought up politics as a necessary requirement to sort of launch or increase the size of this market. And prior to the elections this past weekend, the mood seemed to be quite positive for a lot of the regulatory advances in Europe. There's a lot of discussion on completing banking union. There was discussion on advances on capital markets union and on the overall market for securitization. And my question is, how much has that changed as a result of the European elections? Not overall, because overall the number of seats for each different party is roughly the same in the European Parliament, but particularly the results in France and Germany, which, as everybody here knows, has caused snap parliamentary elections in France, and discussions about how long can Scholz's coalition last in Germany. So I guess I'll start with you, Nathalie, to ask for a comment on that.
Of course, I will not have any political consideration here. No, the good news from our side, but maybe it won't be shared, is that all the regulatory framework regarding Basel III has been adopted in Europe. So it means for me it will not change anything. It will be published on the 19th of June by the EU Commission, and will be implemented from the 1st January 2025. So this election comes after everything has been decided. So I am on the safe side for the implementation of Basel III, because we continue to think that we have to implement fully Basel III, of course, with a look of what happened in other countries, and I think the European Commission has the possibility to use the delegated act in order to postpone the implementation of some aspect of the Basel III regulation regarding the market regulatory framework. But I would say, at least, I think this will be implemented. So on my side, it's a good news, maybe not for everybody. And as you mentioned, the majority won't change at the European Parliament, so it means that some elements of the work might be still supported by the European Parliament. On the Council side, maybe it will be more complicated. Yeah.
So Fabrice, what's your take on that?
Well, it's not an easy question, but I try to be positive despite the context. I think the first lesson is that the whole idea that the EU is needed is not questioned anymore. Maybe these are lessons learned from the Brexit, but when you look at the political campaign, political parties advocating to quit the union are very, very few now. Now the discussion is what to do with the union, which is normal, but that's a first point. The second point, I fully agree with Nathalie. The prospect is that the parliament will be relatively stable compared to what was thought. So priorities might be the same, but nevertheless, I think it's important to listen to what happened. And I drafted a report for the ECOFIN a few years ago suggesting to change the name of the Capital Market Union. And rather than something that people spend time in creating capital markets, it's, I think, more important to explain to people why this is important. And that's where we suggested that it should be called a saving and investment union. Saving speaks to people, and investment, people can understand why it's needed. And I'm happy that this idea is gaining some momentum again. And the other point is that in the two previous legislative cycles, CMU was presented as a priority in itself. I think the reality is different now. I think the priority is to find financing to finance these 2 or 3 transitions: green, digital, or artificial intelligence-led economy, and strategic autonomy. So a lot of financing is needed. And therefore, I think if the political leadership agrees that these transitions must happen, and there is a need for financing, then the question on how that financing is done, it's a more technical issue. Financing will be the tool to achieve that objectives. And therefore, the technicalities of securitization or other aspects should not be a discussion between leaders. They just want this to happen. So I think to explain that to leaders, it makes a difference. Now, you're right. Leadership is nevertheless key for that. And in Council, how France and Germany will be leading or not remains to be seen. And last but not least, I think the personality of the commissioner in charge of this issue will be very important in terms of giving impetus or not.
Thank you. And Alain, do you have a similar perspective from being inside a bank, or do you view it differently?
Look, I think we'll remain in the same vein in a way. I don't see a dramatic change through the election, European at least. A French one could be another topic. What struck me when I looked at the programs of the different parties is that everybody puts on the table the sovereignty in terms of defense, the sovereignty in energy, but how do you finance that? Nobody says a word. Probably because we lack people who understand that to finance you need cash, in a way, by one or another. The second thing which has surprised me in the campaign is that the major political event of this year is not the European election. When you travel the world, nobody cares. The real event will be the election in the US. And if the Republicans win the election, everything which is Basel III, etc., will go to the garbage immediately. Yeah? And we continue to process like if we were alone in the world, and we'll pay it very, very hard. And when you go to Brussels and you talk to people, nobody listens to you. They believe that the world turns around the Belgian capital. That's not the case. Then I do not believe that the European election will change anything. We may see, given the extremes, probably a little bit more protectionism or even isolationism, which is not good for Europe. But I think the real topic is not capital market union. The real topic, as Fabrice was saying, is we have an economy in Europe, and how do we finance it to keep, in a way, or to sustain our independence? The rest after that are tools, only tools. And I think this conscience is unfortunately not yet there.
So you mentioned tools, but tools are important. So Alexander, you know, I guess from your perspective too, and again, it's nice because you have a view where you look at lots of different markets, both inside Europe and outside Europe. Do you think that the use, the changes in those tools, whether again it's CMU, banking union, Basel III, will that go for the better in the EU or not? And is it changed at all by the changing dynamics in the politics?
So the changes of the last few days, and I have to admit that I've been answering this question ever since Sunday night, and I was in the US
So you've perfected your answer at this point?
Sorry?
Perfected your answer at this point?
No, just continuous flow of questions from US and Asian clients. Let me just give you one example. We have quite a few clients globally who want to build a portfolio, a global securitization or structured finance portfolio. By the way, I use the word structured finance because it's not only about ABS, MBS, it's also about private capital, it's also about infrastructure finance, it's also about credit derivatives, portfolio credit derivatives, and so on. And they get a lot of allocation because it's very fashionable now to have alternative assets. And they're the ones who have performed extremely well in recent years. And with the potential terminal rate in ECB coming below 2% potentially, given the current output gap of the Eurozone economy, we're probably going to see significant rate cuts, which will probably force people to look away from risk-free assets and build up risk portfolios. And you're looking for less risk-sensitive portfolios on a credit basis, not so much on a duration basis, because that's another matter. So the question is, if I have, again, 100 billion and want to build a global securitization portfolio, where would I put my asset manager? And the answer is not EU. Probably Switzerland, maybe a bit now better in the UK, because UK changed the regulations in April, going to force on November 1st. But maybe I'm better off staying in the US or actually sitting in Singapore or somewhere else. So the political change in the last few days, especially Germany and France, raises the question about the volatility and question about, are we going to have the desired change? Until a week ago, I was relatively optimistic about the desired change because I was thinking we have very strong momentum from European Council. Now the European Parliament composition came more or less as expected. Of course, it depends who is the rapporteur, who is the head of this commission, or other personal, subjective aspects, but it seems decent, positive. And we knew that there was a driving force in Germany and France. Now it remains a question whether there will be a driving force in Germany and France when it comes to the bridge to the economy, which is securitization, banking union, capital markets union, for the purpose of the economy. And then we have ECB as the fourth pillar, in a way, of the European financial system. So how do the three co-regulators are going to come together to move the changes? And I have to say, we don't need very big changes to move the changes in the right direction, to say to the world, you're better off coming in Europe, putting your asset manager here, building your securitization portfolio here with European and non-European assets, and driving more the European economy with European savings. That's, for me, the question mark, and I'm still guardedly optimistic about the outcome, but let's see what happens in the few elections that are coming in the next few months.
Thank you. So the Association for Financial Markets in Europe also appeared to be very optimistic last week, again, before the European elections, when they published a paper called EU Securitization Back on Track. It's very positive. It has 5 proposals to increase the supply and demand for securitized products in Europe. And my question for you all is going to be, to what extent you would agree or disagree with their 5 proposals? And those are: 1, increasing risk sensitivity within the bank prudential framework; 2, reviving demand from the insurance sector by adjusting Solvency II calibrations; 3, adjusting the ratio of securitization within the liquidity coverage ratio; 4, introducing proportionality for investors conducting regulatory due diligence; and 5, fine-tuning the regulatory reporting requirements and simplifying STS criteria for both traditional and synthetic securitizations. So I guess, and I'll sort of reverse the order, and I'll start with you, Alexander. So how aligned are you with those proposals? Which ones do you think are workable, doable quickly, and which ones do you think you disagree with?
I mean, I'm perfectly fine with all these proposals. I could write them myself. And very happy to do so. But let's go slightly deeper into each of them. Increased risk sensitivity of bank prudential framework. The constant argument we're hearing that Europe has to change CRR in sync with Basel. Well, we don't have to wait for Basel. We didn't wait for Basel when we needed to fix covered bond market. So why do we need to wait for Basel if we just need to introduce risk-sensitive output floor? Simple as that. Number 2, insurance sector. That's always been the big problem in Europe. I'm hearing all kinds of explanations why the insurance are not investing. Oh, they don't want floating rate assets. Oh, they don't want short duration. Why did they invest 10% of their assets under management in 2009 in European securitization? So it's not the duration, it's not the floating rate reference. There are other reasons. And one of the reasons is the excessive regulatory capital, especially for non-STS. Number 3, STS, we have to fix it. What do we need to fix there? To invest in STS and ESG bonds, you have to do more work for less pay. In a very simplistic way, it's, do you want to do this? So how do we fix that problem? Adjusting the liquidity coverage ratio. There should be some comparability in the liquidity coverage ratio, but also in the capital charges. You cannot be talking about a portfolio of 80–90% LTV mortgage, 30-year, having much less regulatory capital charge than a 3-year duration AAA RMBS. And the same thing for covered bonds. You cannot be pushing covered bonds STS, RMBS or auto ABS with 1.5-year duration, perfect behavior to 2B LCR. It should be at least in 2A, or it should be comparable with some other products which are 1A. And then introducing proportionality, investor conducting regulatory due diligence. Securitization is not a retail product. Securitization is an institutional investment product. To tell large institutions prescriptively how much work they have to do to determine the risk they're buying and how to price it, I think it's a bit extreme. So maybe this is another thing we need to fix, then not to mention disclosure, which we already discussed. But just on the disclosure in STS, European STS has on roughly 2 times more criteria than Basel STC. Do we need that?
Alain, I know that you, I think, have a few issues with.
Alors, I am much less expert than Alexander, but I think the few things could be solved very quickly if a political decision is taken. The first one, revival of capital market union and securitization, if Solvency II is not reviewed, will not work. Because the equivalent of pension fund in Europe are life insurers. And if they have the choice with a product which costs them little equity, which is usually government bond or a AAA paper securitized, that's their goal in a way to take the government bond. Then I have a feeling, I told you that, Alain, that some governments are a little hypocrite around the topic. They fear eviction. And they will have to place their government securities. Then they're okay for securitization, not too much, because they fear on their own debt. Okay, then they will not be financed at all one day for their corporate, that will be their choice. Second thing, if the paper is of good quality, it should be HQLA. And if it is HQLA, it should match whatever the LCR ratio. And the last thing that Alexander mentioned, and I'm sorry, but you are not in charge, Nathalie, the process at ECB. If you want to have a securitization done the last 10 days of December, you need to send your file at last mid-February. Otherwise, forget about it. That's not what I call agility, if you see what I mean. Then it's a very burdensome process, and it shouldn't work that way. Rules should be simpler, and process should be simplified. That's the reason why in AFME, I only read the fifth comment, which was simplifying. This one I loved.
Good to know. One thing out of curiosity, is that exaggeration, or do you literally mean it? That at BNP you send... So you send in February for approval. In
2023, the file was sent to ECB in February 2023.
Wait, could you repeat that with your microphone?
No, I have a true example.
Yeah. So
A true one that I can show to show that it's a lengthy process.
Thank you. So Fabrice, coming to you for your take on these proposals.
Very quickly, because a lot has been said already. But again, if the objective is to facilitate financing, then I see that priorities number 1, 2, 3 are the most structural ones, because that will change the capacity of both supply and demand on the market. The market is where supply and demand meet. So whatever eases in terms of capital and capacity for the players to enter the market must be promoted. I'm sure burdensome requirements and lengthy supervisors can always be improved, but the structural ones are the three first, because that's really where capacity of that market to function is.
Thank you. So Nathalie, I imagine that you have a slightly different point of view, perhaps, on these proposals than your colleagues.
Maybe I will surprise you. No, I'm not so in a disagreement with these because, as I said, the ACPR is very much in favor of having a more proportionate regulatory framework, and even in terms of supervisory processes. So I'm not really in opposition with all this. The only thing is that we need to keep a safe framework. So, of course, securitization is, for example, more complex than covered bonds. So you need to distinguish between maybe junior tranches compared to senior tranches. So, of course, the framework is a bit more complicated, but for safe, standard, and even with very good underlying assets, I think we can improve the framework. The only thing is that we, of course, need to have good standards, which was not the case in 2008, and that's why, of course, the process to come back to a more normal, more proportionate framework, it takes time. So we need to have a resilient and a safe framework. And in order to make some progress, we have to address these issues through different types of regulations. So we have the Basel regulation, which is the one where we discuss capital requirements. At the ACPR, we really try to keep this on the work program of the Basel Committee, but it's not so obvious. All in all, there are very few countries interested in reopening this discussion. And the way it has been adopted in Europe is very close to the Basel framework. So here we would prefer to reopen the discussion at the Basel level, because this part of the Basel III framework has already been adopted in 2019, because it is the first phase of Basel III. Regarding Solvency II, I fully agree with Alain. We would be in favor of alleviating some aspect of the capital requirements, but it has to be within Solvency II and revision. And it is not very clear whether it will be in or not. We need a will. We hope we could at least get the possibility to initiate an assessment of the current regulatory framework. It's what we hope, you see. So we are trying to get that. Maybe, and it is where we have, of course, a big question mark, because there was this strong push toward capital market union, securitization. Maybe the Commission could decide to open a more comprehensive and cross-sectoral overhaul of the securitization framework in Europe. But this is not on the table now. It could come because of this big push, but it's not on the table, and we don't know exactly how the work program of the future Commission will be set. So just to say, not in disagreement. I think it has to be done for the safe products, but we have to find the right vehicle for that.
So one quick question, actually. I have a series listed, but it brings up one thing. So you did sort of call out the difference between sort of the safe framework, and without really mentioning it, but saying, but you implied, or it seemed to me that you implied basically Europe needs a safe one, the United States does not have a safe framework. Is that your opinion?
I don't say that. I just say that the securitization we saw up to 2008 was not safe. And that's why also when I said that current outstanding amount is around half of what it was in 2007, it's because part of the securitization was not safe products. So it's normal that we have a decrease in the overall amount because all regulators and all supervisors want to have more safer products. Now, of course, we tend to be very much on the safe side in Europe because we have capital requirements which actually are quite close to the Basel III agreement on securitization. But it's true that at the European level, we have added reporting requirements, due diligence requirements, which are much much bigger. And when you addition all this, the stamp for STS by the ECB, it is a heavy burden. So let's look at what is really reasonable, what is appropriate, and what is going too far.
Thank you. So Fabrice, I wanted to come back to you for a minute, and we've discussed sort of the links between CMU and banking union, Solvency and how they work, Solvency II and how they work together to either promote or hold back securitization. So from your perspective, what is the interlinkage between those various aspects, and how do you sort of, what are the ways, the tools that you need to work on in order to try to push forward securitization?
Well, I fully agree with what Nathalie said, who is supervising both sides of the market, in fact. But the purpose of the banking union was to create a banking system that could passport and provide services across the 27 countries. And at the very beginning, the capital market union was post-crisis seen and proposed as a tool for more private risk sharing, meaning because the price of the crisis was on the shoulders of the governments and in fact the taxpayers, and there was a real will to change that and not tap the taxpayer once more, which is difficult to explain. So there are myriad of solutions, and one of them was, could we create more private risk sharing? And in that aspect, the securitization market is a perfect tool, because it alleviates, as I said, the balance sheet of the banks, and it spreads the risk into the market to various investors. And in case of crisis, then it alleviates the burden for the governments if they have to save banks or the whole financial sector. And again, securitization is the perfect synergy between the two. It allows this private sharing of risk. It allows to alleviate the balance sheets of the banks and therefore to increase the capacity of the banks to lend. And it creates a market where allocation of capital and risks is better achieved and in a more efficient manner. So this is really a good example of the way the two should go together. Now, the banking union is not finished, despite what people believe. There is still a lot to do in terms of integrating or allowing major banks to have an integrated strategy in an integrated market. And the capital market union is still a myriad of technical files that are progressing slowly without a strong objective, where key pillar or structural things are missing. We miss long-term capital that can be invested in long-term investments, and we have a poor equity market that can be much bigger compared to the size of the economy and the integration we are looking for. So there is work to do, but this is one of the solutions to help that political objective at the end, which is to finance these three transitions that political leaders have already agreed.
Thank you. And so, Nathalie, I wanted to come back to you. You mentioned earlier Basel III, and that Basel III is done from your perspective, and that you were very happy with that. I wanted to ask you also about Solvency II. How does that, what is the impact of Solvency II and potential changes in it to the securitization market?
As I said, for the time being, we are on our side quite satisfied with the content of Solvency II, the revision, in terms of the fact that it should not have a significant impact on capital requirements on the insurer side, and it would favor more long-term investment in equity. So all these aspects are very favorable from our point of view. On the securitization side, nothing has been really put in the Solvency II revision, and we think that we should have the possibility really to open and to launch and to initiate an assessment of the securitization framework within Solvency II. And if we do that, and if it is shown that really the regulation is unfavorable, unduly unfavorable, in that case it will open the way for some development in the and change in the regulation.
Great, thank you. And now again, coming back to your bank perspective, I guess what are the measures that you feel that you need to push hardest for to foster securitization? And I know that you agree that banking union is not done, but can you talk about some of the issues that presents to you?
I would say on securitization, obviously, as Nathalie and Fabrice said, the simpler will be the rules, the easier it will be for banks to securitize not only their own assets, but assets of their clients, finance company, and so on. After that, if the rules are clear, I think the process of agreement, based on what I said before, should be delegated to local supervisor. For me, the ACPR is much more agile, competent, etc., than Frankfurt, by far. I have nothing to German because we are controlled by Italian and Spanish, but it doesn't work. And the third thing, we need to reopen the Pandora box of Solvency II. Because if insurers are pushed by their own regulation to invest 80% of their assets in government bonds, they will continue to invest 80% in government bonds. That's the reason why after every work on new products across Europe which are positive, are worth nothing compared to reopening Solvency II. If you want to have investors in Europe going to market, equity market or bond market, you need to reopen Solvency II. Other than that, we create a new product to be distributed by banks with a lot of compliance, etc., and it will be very limited results.
And then finally, Alexander, I wanted to come back to you again from your international perspective. You've talked about how you know the size of the U.S. market versus the European market. You mentioned I think Australia in passing. So what works well in some other markets outside the EU, whether it's Japan, Australia, and even the United States? For you, what are the fundamental things that the EU should look to say, like, actually that's been quite a success?
So it is often said that we cannot compare Europe with US because of the US agency market. But let me just clarify one thing. From a pure definitional point of view, US agency MBS are not securitization. There's no tranching. They're pure pass-through bonds, financial institution bonds, with or without government guarantee, or conservatorship, not to go into the technical details. What happened in Europe is, in the US, is that the collapse of the non-conforming or subprime market led to complete change in underwriting criteria, and the banks continued shifting the mortgages away from balance sheet, but this time not into the private sector, private label securitization MBS, but into the agency MBS. That's why we saw decline in RMBS securitization. The US mortgage market MBS private label took about 12 years to get back to 100 billion or roughly 100 billion issuance. What happened in Europe? the decline in mortgage-backed securitization, like in countries like Holland, Holland is a prime example of the shift, led to a significant increase in covered bonds. The covered bond outstanding in Europe doubled between 2008, 2009, and now. We're talking about 2.2 trillion from memory for the European market. That's significant funding on banks' balance sheet. So here's one of the main differences between Europe and US. Covered bonds remain on banks' balance sheet. They're balance obligation of the bank. US agency mortgages are not on the bank's balance sheet. Their capital is completely independent. So the banks are free to originate more. That's number one. Number two, both Australia and US are moving away from bank funding into non-bank funding. And we saw recently, I think the Financial Stability Board did a very detailed study on securitization, and I recently saw 3 charts which compare the composition of US market, let's say 80% or 75% capital markets, the rest banks. Capital markets meaning also non-bank financial institutions. On the flip side, Europe, I think it was about 80% banks and 20% capital markets. And Australia was somewhere in between, but more like 60% banks and 40% capital markets. But moving in that direction, because what we have seen in Australia is banks shifting whole business lines out of their balance sheets. In the last 5 years, the Australian banks have effectively eliminated auto origination, auto loans and auto leases almost entirely in the private sector. What allowed this to happen was private credit, private capital. Many of these companies are owned by private equity. They're built to be funded on the market, and they're built to fund the market, to pass the market rate to the borrowers and price it that way so it can be funded on the market. That's something that we don't quite have in Europe. How we are going to shift remains to be seen. So there are many differences, and one of the other differences I want to emphasize is when we hit the global financial crisis, the securitization market ceased pretty much everywhere. And in Australia, the government basically stepped in and said, this market is very safe. It's a liquidity issue, it's not a credit issue. And the Office of the Financial Management, AOFM, of the Australian government started buying ABS on the secondary market. They established 2 programs, total 30 billion, and they gradually allowed for the pricing to recover. They made money when they disposed of the MBS, and gradually the market restored. So Australian market today is almost equivalent to the levels and volumes we saw in 07, 06. In Europe, we had ECB step in, but ECB was very reluctant. Their peak purchases were outstanding was 32 billion, but ECB was never a price setter. ECB was the price taker. They helped the volume, but not the pricing. But at the flip side, they were extremely active in corporate bonds and covered bonds, and if you look at outstanding, more than 300 billion. So the disposal of these holdings, they are gone almost for ABS because ABS are amortizing, but the others are not. They're bullish, so they'll be haunting us for quite a while and holding on the bank balance sheet. So many, many differences. The point here, in my view, is do we want balanced financing between banks and capital markets on the economy? How much are we going to allow non-bank financial institutions to step in? Do we want to let massive amounts of private capital stepping in because they're already buying large amounts of consumer credit as opposed to corporate lending, which they practiced initially for private equity? And how do we balance all these things in a very functional, sustainable, there should be always some risk left. We cannot do everything riskless because we'll never lend any money, in a sustainable way to support the European economy. That's all it is.
Great. Well, listen,
I just wanted to add, because it probably gives the feeling to the audience that banking union is done. Just want to reassure everybody, it's not finished. If you are BNP Paribas, you have cash trapped in any country in Europe where you have retail, because whatever ECB is seeing, the local central bank blocks your cash. Belgium, Luxembourg, Germany, and Italy. That's Europe.
On that very positive note, then, I'll have to say, Banking union left to be done. Capital markets union left to be done. Basel III, though, mostly done. So I guess we have our good points and our bad points. But it sounded like there was some optimism continuing about the progress of securitization in Europe, though I would have to say it seemed a little bit less maybe than I would have thought coming into this. But never give up. As you say, never give up. Well, thank you very much. I want to thank my panelists. Thank you very much, and have a good afternoon.